More, let's go to David Madden, a market analyst at Equity Capital in London. Welcome back to the program, David. Always good to have you. Now, can you just walk us through this spike in energy prices in the last couple of hours? What's worrying investors and market players?
Well, as you mentioned in your intro, OPEC Plus have actually fallen behind their own targets in terms of production, and with that has led to a continuation of a squeezed supply amount of oil being available on the market. That's driving up demand. We also have fears about what's going to play out in terms of the mainland European economies, in terms of energy security. People are scrambling around to ensure that they have enough fuel stockpiles to season through the winter. And also, in the last few hours, we have heard increased rhetoric out of Russia in relation to the war in Ukraine. That's really ratcheted up fears that things are going to get worse before they get better on that front. And that is just kind of, you know, the last kind of final kind of component which is driving up the oil price. And when in situations like this, when there's escalating tensions, or even, you know, another kind of potential round of increased violence in Ukraine, uncertainty over energy, and on top of that, OPEC aren't even actually meeting their own production targets. Traders typically fear for the worst. So even if things, all these scenarios actually aren't as bad as originally feared, just the very fear itself is enough to kind of drive the oil price higher, and that's precisely what we're seeing. If you look at the price of oil in the past 12 months or 9 months, although it has been in decline in the last few months, the losses we've seen on oil are nowhere near as bad as the sharp declines we've seen on other industrial commodities, such as copper, for example, because it's to do with these squeeze supply levels coming from OPEC, and also the uncertainty about future supply lines because of the war in Ukraine. So to a certain extent, that's always kept oil at a relatively high level compared to other commodities such as platinum or silver or copper.
So how does this change inflation expectations moving forward? We know central banks are raising rates at a rapid pace, and if for some at a historic pace, what happens now? Well, how might central banks react?
I think, unfortunately, for central banks, their difficult position is going to remain the case. Central banks are hiking interest rates as a way of driving up the borrowing cost, as a way of impacting demand. But hiking interest rates isn't going to alter oil prices. So they've got the tough task of bringing down inflation, when sadly for them, a lot of the actual drivers of inflation, food prices and energy prices, as we're discussing, are beyond their remit, are beyond their control. So I think central banks are now going to have to continue the route of hiking rates, driving up the cost of borrowing. That should dampen demand, hopefully actually avoid a recession, but that's actually something that central banks could actually do for their respective economies, or at the very least put the brakes on the economy to kind of quell demand, and then in turn that should lead to a fall in commodity prices, and that should lead to demand across the board, and those acting in unison should help bring down inflation.
All right, David Madden at Equity Capital in